So thanks for inviting me. I'm a cryptographer by training, which people don't think is a real job until now that cryptocurrency is really popular. So I'm a visiting fellow in computer science. I do a lot of work in kind of fraud and manipulation of networks. So cryptocurrency networks are a fascinating place to look for fraud and manipulation. Here we go. Oops. So I didn't kind of know the audiences, I didn't kind of gauge people's interest or experience with cryptocurrency, but these are some really interesting books to read. For those of you who actually read books these days. The first one, it's a book out of Princeton. It's kind of the canonical textbook on Bitcoin and cryptocurrencies by Arvind Narayan. He's a Princeton computer scientist. So that's a great book that's used in a lot of courses, and there's a really popular Coursera course. If you haven't taken those kind of MOOC courses, it's very, very good. Digital Gold's a nice kind of cultural history from a New York Times columnist. And the last one, if you're interested in Silk Road and the takedown of the dark net, it's a fascinating book about how that actually happened, how they caught Ross Ulbricht. So I like these quotes. I don't come from the world of fintech, but I love these quotes about Bitcoin from these old-timey people, that it's rat poison squared, and it's like, it's fake, it's out of thin air. It's really interesting that these same companies are now delving headfirst into crypto in various ways because there is money to be made. So Bitcoin turned 10 years old last week on Halloween. This is this paper that was published, and if you are new to crypto or want to get into it, it's all about the white papers. You'll see this everywhere. Read the white paper. I've got a white paper. So the white paper was published 10 years ago, and the first actual transaction using Bitcoin was someone who bought 2 Papa John's pizzas, and that was 10,000 Bitcoin back then, which you can imagine those are really expensive pizzas. I think these are equivalent like $50 back then. Now that's quite a lot of money. And then Ether turned 5 years old. So Ethereum white paper was published, and then the cryptocurrency called Ether was born in 2015. So what's different about cryptocurrency from kind of the traditional financial markets? If you're not familiar, if you don't own Bitcoin or any kind of cryptocurrency, deposits and transfers are irreversible and they're permanent. So if somebody gives you their address, which is a string of numbers, and it goes by numbers and keys. If you deposit or transfer Bitcoin to somebody using those, it is irreversible. So if you fat finger in the wrong number, your Bitcoin is gone. If your private key is lost, and you hear a lot about how to hold private keys, and I'll talk about that, it can't be recovered ever. And there's stories of people who lose their hard drive with the keys, and they throw it away by accident, and they're going through the dumpster for days because that's $500,000 of crypto. There's all these kinds of stories. It can be pseudo-anonymous, and I'll talk a little bit about the security challenges with KYC AML for exchanges. Some is actually anonymous. Some cryptocurrencies like Zcash actually started out with the intent of being anonymous, and that from a security standpoint, that presents other challenges. No one's in charge, as we know, is kind of this cypherpunk wanted to go outside the system. So there's no central bank, no regulation, but regulation is starting to be introduced at various levels, which is very, very interesting. The blockchain consensus mechanism is really hard to break, and it's difficult, by and large, for kind of average investors to access. It's hard to mechanically, the interfaces aren't great. It's hard to understand what a private key is. How do I keep it? Though that is slowly changing as places like TD Ameritrade and Fidelity and Goldman, they want kind of your average Main Street investor to put 5 or 10% of their portfolio in crypto. More people are asking. So what's a safe way to do that? So that's changing quite rapidly. KYC AML can be more of a challenge. It's a little labor intensive. There's robust processes that have been set up for banks to do this. It's a little harder in cryptocurrency. And the assets can have a history and provenance. So can paper. Cash can have been used for a crime, but for Bitcoin, that history is on the blockchain forever. And there are certain tools which will tell you as you're bringing somebody in, and you can see that Bitcoin was maybe used for Silk Road or dark market type transactions. Institutions have to figure out, how do you handle that? Do you really want to know? Do you care that it was 5 transactions ago they did something in the dark market? It's something there's not a lot of regulation about, and it's something that people have to wrestle with their kind of philosophical views as an institution. So where is it bought, sold, kept, traded? It used to be like, I would go to like meetups, 5 years ago, and there'd be a guy, and you'd have your phones, and it was all, you'd be looking around. Luckily, that's changed quite a bit, and there are more exchanges that are about. Many of these they have varying reputations and varying fees, various types of crypto you can trade, from kind of the big four coins, Bitcoin, Litecoin, Ether, to various coins that start up with various different names. Most exchanges are centralized, and so you hear these terms centralized and decentralized. That means that you deposit your cryptocurrency, you give them your Bitcoin or Ether to hold. They allow you to trade using a matching engine that's usually proprietary, but the exchange keeps your funds safe. And this is probably the biggest security challenge we see at exchanges. Some are decentralized, and then there's some that are kind of combinations, but decentralized means they do not hold your funds. So they don't want the risk. You don't need to trust the exchange and their honesty. There have been a lot of big hacks at exchanges. You don't need to trust them. You can keep the funds. Maybe it's an escrow or your personal wallet, and they are purely a matching engine. So some traditional firms, in fact, a lot of them, especially in Chicago, are getting into crypto via something called custody. So that custody is still a little, from a legal standpoint, there's a lot of legal work in this area on what does custody mean for cryptocurrency. But places like, right here in Chicago, Northern Trust, Fidelity, Goldman Sachs, they are either doing or looking at custody. So their whole business model for crypto custody is just to hold the cryptocurrency for a trading firm. And, it's fairly safe for them. There's a lot of robust operational processes, but it kind of allows them to get into cryptocurrency without a whole lot of risk. So in order to have, the Warren Buffetts of the world embrace crypto and not think of it as rat poison, there's a lot of regulation that's in process. So there's two kind of main arms when you think about regulation, the SEC and the CFTC. And I've been doing a lot of work for the past 3 months with this crypto exchange with the CFTC. Because the exchange that I do some consulting work for, they were looking to be an actual clearinghouse. So the CFTC has some pretty prescriptive guidance on what makes a clearinghouse and what makes an exchange in cryptocurrency derivatives, what you need to do. They're still wrestling with it, but they're fairly specific on what you need to do to be authorized by the CFTC. You have to show you do monitoring. You have to show that you have custody of the funds. You have to show that the funds, you can recover them. The SEC regulates digital tokens, nearly all of them, as securities. And that's kind of another area of interest for the legal community, is kind of issuing bulletins saying these ICOs, how much of a risk are they to kind of Main Street investors? And they've refused to approve cryptocurrency ETFs because the safety, the lack of liquidity. So that's something that's still kind of in flux. SEC established a cyber unit, not just for cryptocurrency, but for all kind of digital asset investigation. And just, I think right now, I looked it up a couple weeks ago, they have 250 active investigations going on. Pump and dump schemes, they've been going on for a long time in cryptocurrency, but they're actively trying to get a hold of it. And then this new task force on market integrity and consumer fraud, it's a broad task force, but there was a specific arm around digital currency. And this is across not only DOJ, SEC, the Federal Trade Commission, but various other agencies to really kind of crack down on cryptocurrency. It's still to be determined what they're going to do. So some of the threats, these are kind of the bigger, kind of work from like the broader, cryptocurrency in general threats that, you wouldn't see every day. But in general, a 51% attack, you've heard about mining. And really for most of the Bitcoin, for all the Bitcoin, it really comes down to 4 or 5 major mining operations, mostly overseas. But were they to get together, and 51% of them would be the majority, they could have the majority of the hashing power and do nefarious things. That probably won't happen just because there's not a great incentive for them to do that. Eclipse attacks, where they can isolate the victim. There's a lot of smart contract bugs. So Ethereum has this ability for smart contracts, which is another kind of in flux with the legal community. What is a smart contract? But these inherent weaknesses in the actual language of those smart contracts, particularly if you've heard of the DAO, MakerDAO, or the DAO, they had this recursive call bug, which really wasn't a hack. It was a software bug, was used to make multiple withdrawals when only one should be allowed, thus the recursive nature of it. And it ended up with $40 million of Ether being stolen. And then you see things like BGP hijacks, which is a very easy network hijack. It was just this year where users are directed to a bogus site. They got a fake certificate. They couldn't tell. And it was redirected to a nefarious person in Russia who stole all their Ether. So some of the threats to exchanges. So there's several exchanges that are in Chicago, and I'll talk about one I work at, but there's several others that are based here. And some of the big threats, of course, DDoS attacks. These are a threat to any institution, but they are a real threat to exchanges who, by and large, many of them are putting stuff in the cloud, whether it's AWS or Google. Their matching engine, their stuff, their infrastructure is in the cloud. So the threat of DDoS is pretty big. And if you look at these kind of services that look at DDoS mitigation, I don't know how they came up with the number, but 74% were targeted with attacks. And you can see that traffic pattern just because it's a huge target of opportunity. KYC AML evasion, there's a lot of process that goes into this. And, how do you know that when you onboard somebody, who they really are? Some exchanges will onboard anybody with a driver's license. You know that driver's licenses can be faked. They can be bought off the internet. How do you know that this person's real? What if your credit is frozen? At that point, when you do the KYC AML check, it'll come back that you shouldn't authorize them, but it's just that they're being good with their credit. So lots of kind of process around, are they a real person? Are they a fake person? Because if they're going to trade on an exchange, you want to do your vetting. Money laundering is pretty common. Not so much on the larger exchanges, but what people do is if they have a big pile of crypto that is acquired on the black market, they will spread it across a bunch of exchanges and trade there. So kind of tracing that back can be challenging, but if exchanges want to stay above board with security, they will put some money and effort into tools and some kind of data science analysis to look at that. Access to users' private keys. Once these are lost or stolen, the money's gone. So keeping users' keys safe, because the exchange holds keys, holds passwords, is very, very important. An insider threat, of course, this is a lot of money, so you want to make sure your kind of software development team isn't also the people that are holding the cryptocurrency and having access to user withdrawals. So it's all about keeping wallets secure. Your wallet is the cryptocurrency. If you've heard of wallets, there's some on the bottom. One is called the brain wallet. You remember your password. Probably not the best thing, but you don't write it down anywhere. People print it on paper and keep it in a safe in a lockbox. They put it on these little devices that are purposely made. All they do is hold your private keys. A hot wallet is where you keep private keys online. And when you're running an exchange or someplace that does cryptocurrency, you want to keep kind of a small portion online. And that's for if people write, today I want to take out my money, it's accessible right now. The cold wallet, that's where most of the funds, generally like 98% are kept. And these things are kept in like literally Swiss bank vaults. Like they will actually have vaults underneath a mountain, and it'll take 2 to 3 days to get your money out of there with a lot of operational processes around it. Custody, again, holding, custody is kind of the sweet spot because you're holding digital currency on behalf of a client. It's the process is generally outsourced to third parties to minimize risks, and that's why these big kind of old-timey banks are now getting into custody. They have a lot of processes, and they're kind of used to doing this with real money, so crypto is a natural extension. Legalities are a little unclear. There's some work in this area. Custody is very expensive, and it's very vulnerable. Generally, these things have like a $100K setup fee and 10 basis points a month with a minimum of $10 million in the account. I mean, that is not an insignificant amount of money, but there's a whole lot of process wrapped around it where they have, people, armed guards at the vault, and people are driving there with little USB sticks, and you're getting on the phone with others. So when we talk about security, this is like serious, NSA level security to get that crypto and send it back to people. So emerging threat model, again, these are kind of similar to what we see in finance now, but social engineering is kind of magnified. People, they see these Twitter feeds from famous people in crypto and say, hey, you send me this for my ICO and I'll send you this back when I make it big, and people fall for it. I mean, it's a scam. It's an old-time scam. Human risk, there was a couple of traders in England, and they had their baby taken out in the stroller outside while they were held at gunpoint, and the intruder said, give me your wallet and give me the password, and they took the crypto. So some people have this duress wallet where they'll give them the USB and password with kind of a little bit of crypto, but not all of it. Phishing, this is kind of typical. So two-factor authentication is critical in this situation. Pump and dump schemes, normally seen with smaller. You don't so much see it nowadays with big coins like Bitcoin or Litecoin, but smaller coins, as people release them, they'll get their friends together, inflate the price of it, and cash out. And some of the work I do is tracking that activity. And then there's exchange hacks. There's been a couple of really, really big ones. Generally, they're DDoS attacks and kind of insiders, or a combination of the two. So some best practices, what we're seeing is these best practices are a combination of kind of old school or government regulation and thinking about what the threats are and looking at that. So, part of what we do is follow the NIST guidelines. They're super boring, but very prescriptive and still have a lot of good things to follow. A multi-signature wallet, so you think about the risk to that wallet. It's multi-signature, meaning you have to have either 2 or 3 people, 3 or 5 people, whatever it is, in order to approve a transaction, because these tend to be lots of money. You have to have a digital signature scheme with more than just one person who's allowed to get that money to somebody else. Keeping only a fraction online in the hot wallet, and a very stringent operational process. So these keys, obviously, since you really don't want to lose the keys, you make backups of the keys. Those backups are sharded, and that is a very elaborate process where 6 or 8 people will come together. Sharding means the private key is actually split into 5, 8, 6 parts, whatever it is. Those parts are then sent to a vault. So if anything ever happens to the real key, you can bring everybody together, they reassemble the key, but there's all sorts of witnesses and processes and multiple employees to make sure that those keys are kept really safe. And a whole lot of very strong software integrity checks to make sure that the software does what it says it's going to do. So identifying fraud and manipulation, these are some kind of flags. Many of the behaviors are very similar to what you see in traditional exchanges, but in crypto, there's some things like you acquire a lot of crypto, but you don't sell it, you don't trade with it. You're probably doing something other than trading legitimately. Using locations, Tor and different VPNs to logging in from different locations. It might be somebody who's just a gig economy type person who's all over trading, or it might be someone who's trying to mask what they're really doing. Email addresses, part of the KYC process is kind of looking through their social media and figuring out, are they who they say they are? An ID doesn't really tell the whole story. And then there's a lot of these commercial analysis tools, Chainalysis, Elliptic, and they use kind of graph theory to look back at the history of the coins and look at the provenance. And then an exchange can make a decision. If this was used in a bad transaction 2 weeks ago, do you still want to take them on as a customer? Maybe, if they have enough money, maybe you do, or maybe you just do some more questioning. Some of the research challenges, which are kind of the broader, longer-term type challenges. There's this notion of Bitcoin covenants. What that means is, in layman's terms, it's a way to, right now, there's no way to stop a withdrawal. If an exchange or somebody, wants to send you the Bitcoin, there's no kind of, okay, we're going to put it and wait 24, 48 hours to see if it's legit. It's gone. So there's a notion of amending the Bitcoin code train to this thing of covenants where there's a recovery key and funds can still be clawed back after 24 hours. Improving the consensus mechanisms and scalability. If you've ever tried to use Bitcoin to buy Starbucks or something, it's at least 15, 20 minutes and quite a hefty fee to do it. So improving the scalability and the performance to be able to make it go more mainstream still remains a challenge. And kind of correctness by design, which is a concept that makes, for developers to have these secure protocols and techniques to create code that we know is correct. And what that'll do is avoid things like the DAO attack were pretty, bugs that should have been caught in the software just were not. And it's kind of an element of formal methods to the programming. So just a quick plug. So I do some work for ErisX. I'm their kind of chief scientist consultant. They're backed by these big companies, TD Ameritrade, DRW, others. They will do spot and future trading for these 4 coins, launching a DCM and hopefully a DCO, pending the CFTC approval. Erisx.com, and they are definitely looking for security people. So if you have any folks that that are security engineers looking to get into crypto, let me know. If you have any kind of research challenges or things that are on your mind about blockchain research or crypto research, let me know. I love to get emails, and I think that's all I have.